Hello, one. Hello, all. Happy Sunday to you, dividend growth stock investors. Colby, the DGI Crab here, back again as I do every Sunday, looking for value in the stock market, trying to find that passive income that I can one day live off of in retirement. But I'm not chasing yield here. What I want to do is acquire some yield and plenty of growth with that. And what I believe the most important metric any dividend growth stock investor should take into consideration is their age and their time horizon to retirement. The younger you are, the more focused on growth you ought to be. The older you are, then it's time to start packing in that income. We have a short trading week this week going into Thanksgiving holiday weekend. So this DGI Crab, in all likelihood, is going to be getting most of my investing for the week done on Monday. I always add to my ETFs on Monday morning just automatically, but I will, in all likelihood, spend most, if not all, of my investing money this week on Monday. Some people might think that there could be better deals to be had on Tuesday. That's all speculative to me. I just know that I'm going to focus on buying bargains at the time that I buy them, as opposed to trying to time the market. I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment. The opinions expressed regarding investments are my own. My personal allocation strategy is as follows, you guys. As you know, I'm putting half of my money every week into age-appropriate ETFs for automatic diversification. When I'm purchasing single stocks, I'm looking for them to be yielding at least 30% or more above their 4-year average yield. Now, I have a top 10 favorite group of stocks. Now, this channel focuses on 60, split into 4 separate age categories or tiers, and that gives us a reasonable amount of stocks to keep track of for our age. But I do have a personal top 10 list in this group of 60, and I'll purchase those even if the value isn't amazing. I stay within my tier unless there's a stock yielding 50% or more above the 4-year average yield, and then I'll jump on that because not only am I getting higher starting yield on a stock that's beaten up, but hopefully some price appreciation as well. And then if there's not a viable stock in my tier, I add more to my ETFs for the week. All right, you guys. So as we jump into the spreadsheet here where I have all of this stuff sorted by the valuation tab, where I am taking the 4-year average dividend yield and comparing it to the current day dividend yield to figure out how far off we are from the current day yield. You take a stock like Waste Management, for example, here, 4-year average yield of 1.5%, current day yield 1.52%. That's right about in line with where it's been over the past 4 years. Whereas you take something like Pepsi, 4-year average of 2.99%, current day yield 3.89%. That gets us into that buy zone category, absolutely. And with this group, my personal top 10 favorite stocks here: Pepsi, Visa, Procter & Gamble, McDonald's, Union Pacific, Waste Management, Exxon, Microsoft, Coca-Cola, Johnson & Johnson. These are the ones that I'm going to buy, not necessarily wait for when they hit this 30% mark. I would be happy to buy Visa right now if I were in that low yield club. Procter & Gamble is right in line with my current age group. So let's jump into the actual tiers here, you guys. This is the 18 to 30-year-old category. This is where we're looking for lower starting yield but rapid dividend growth. You're usually looking at 1 to 2% starting yield in this category, well above 10% dividend growth year over year as a group. United Healthcare, Nike, these two, it's the same old story yet another week. The 4-year average yield continues to climb by about a basis point for each of these two stocks each and every week over the past year. Nike's 4-year average yield has climbed nearly a full 50 basis points. Because it's just stayed down here in the 60s and 70s for such a long time now. They did recently announce a small but it was their dividend increase, keeping their streak alive through the bad times. But out of all of these stocks, as excited as I am about United Healthcare, automatic data processing, after doing their recent dividend increase, is really looking appealing once again this week. Even for me, I'm not in this 30 years or younger category, but getting a 2.69% starting yield on a stock that has been pretty consistently growing that dividend by about 10% a year, I really like those numbers. And also, don't sleep on Visa, also looking appealing after a fairly recent dividend increase out of them in October. Tier 2, age 31 to 41-year-old investors. This is the largest category in the age tiers. Really, tiers 2 and tiers 3 are fairly close, but the stocks in tier 2, I think, are going to be better dividend growers than the ones in tier 3. So that was how I ended up separating them out. But for the 31 to 41-year-old investors, you're starting to add some higher yield here. 2.5 to 3.5% range, high single digit annual dividend growth. And out of this category, so long as Target continues to be yielding above 5%, I am going to be buying it regardless of what age category I happen to be in. That is 69.5% higher than the 4-year average yield, which did tick up 2 more basis points this past week. I update these religiously every single weekend, you guys, before doing the video. But Target still looking appealing. I will buy a 5% plus yield stock like this one, a dividend king growing their dividend for 50 plus consecutive years. I'll get paid to wait on this one to recover. And again, McCormick and American States Water. I love these two stocks. I love all 60 of the stocks the channel focuses on, clearly, but McCormick and American States Water are both just so remarkably consistent. With high single-digit dividend increases year over year, getting them yielding in the high 2% range is a nice way to build up your passive income portfolio if you are 31 to 41 years old. Tier 3, age 42 to 53-year-old investors. I'm in my first year on Tier 3, about not quite a full 30 days in. I'm enjoying it so far. Haven't had a ton of options in Tier 3 just yet, with Hormel being the primary dog here. Also adding Hormel at a dividend yield above 5%, despite their recent struggles. Hey, we're going into the Thanksgiving weekend. Perhaps this is going to be a better Q4 for Hormel than Q3 was. Pepsi, of course, absolutely continuing to add Pepsi so long as it's sitting here yielding comfortably 30% above the 4-year average yield. American Tower, let's see, was it last week or 2 weeks ago? I think it was 2 weeks ago. I added a little bit of American Tower to my Roth IRA. It was right at about that 30% undervalued mark, which is going to have to be closer to about $178 a share to get there. I like putting REITs in my Roth IRA as opposed to in my primary brokerage due to the way that they're taxed. But certainly American Tower looking appealing. Again, it's certainly on the watch list. Archer Daniels Midland flirting with getting back into the buy zone after having at least 6 or 7 weeks of a reprieve from being in the buy zone. Definitely keep an eye on Archer Daniels Midland. I think I want it to drop below $58 a share before I start adding more to it. Tier 4, age 54 and older. The REITs in this category remain our top 3 with NNN, Realty Income, and Essex Property Trust, all yielding at least 10% or more above that 4-year average yield, but not really anything that has me super excited in this category once again. I'll continue to remind everyone, keep an eye on One Oak. I don't necessarily think that adding it at this point in time is a terrible idea. I want to continue to see how One Oak's dividends and even just their overall price go after their acquisition or merger with MMP a while back. But if I think for me, if One Oak's yield top 6%, then it actually may be a little bit more juicy of a buy than our valuation metric might lead us to believe. It's about the only stock on this list that I think that my evaluation metric could be a little bit off on, just again because they acquired MMP, which was trending toward becoming a dividend aristocrat in their own right, or maybe they already were. Very similar stock to Verizon in terms of the yield and how it performed. You could usually get MMP yielding 7-8%, and it was growing its dividend year over year pretty religiously by about 2%. It wasn't MLP. So I didn't ever own any of it because I didn't want to deal with the extra tax form of the MLP. But now that they've been acquired by One Oak, you have qualified dividends with One Oak, with MMP now under their umbrella. So again, above 6%, I think that's the point I am going to start adding it if I'm an income seeker. So now let's talk about our tier buying priorities here, you guys. So if you're in that tier 1 category, I just think about going kind of from left to right here as far as those priorities are concerned. If I were 30 years old or younger, my first order of attack would be adding to an ETF position. I would want S&P 500. I like small cap value as a position, and VIG. Little bit of money into VIG to start building up the dividend appreciation, and then VYMI across the board is my only non-US investment. So these are my 4 ETFs for this category. That'd be about half the money. And then I'm just going to start looking first at my top 10 favorite stocks. Pepsi, of course, in the buy zone across the board for everyone as far as I'm concerned. And then Visa in my own category certainly looks pretty appealing at 15% above the 4-year starting yield. I am pretty excited to buy Visa if I'm in this category. Not really adding any to my Visa position right now. It's just I want to add a little bit higher starting yield stuff at this point in time, you guys, at age 42 to get myself to financial freedom. But I'm very, very happy with the Visa position that I do have. 30 and younger, time to start building that up. In tier value, of course, United Health, Nike, and automatic data processing in that buy zone. And then stocks yielding 50% or more above the 4-year average yield in those other tiers. You've got Target in tier 2, Hormel in tier 3. And then keep an eye on Nordson in your own tier. It's creeping toward buy zone once again, but it is just right on the outside looking in. But keep an eye on it. Nordson, a great stock, one that we've been adding here for a little while now, earlier in the year when it was trading a little lower. Tier 2, your 31 to 41-year-old investors, I still like the same 4 ETFs. I just prioritize them differently, with VIG getting the majority of the capital, while still adding a little bit into the S&P 500 and small cap value. Pepsi is the primary consideration in that group of top 10 favorite stocks. And then your in-tier values are going to be Target, McCormick, American States Water. You could buy the dip in tier 1 with United Health and Nike, or in tier 3 with Hormel. And then keep a very close eye on Texas Instruments, Hershey, and McDonald's. All 3 stocks nearing my buy zone. Texas Instruments has a very high payout ratio that's concerned me here for a little bit. But certainly starting to look very attractive the higher above 3.5% starting yield it gets. Hershey, of course, that was the one that I was buying a ton of for the last 9 months or so. It's starting to recover a little bit, but not quite in that buy zone at this stage of the game. But keep a close eye on it. And then McDonald's, I just love so much. Probably in my top 3 favorite stocks, if I'm being quite frank with you. It is a real estate play. It's a restaurant play. Absolutely love it. Worldwide known company. Just a little bit higher starting yield right now than it typically does over the course of 4 years. I'm not rushing out to add McDonald's, but you could do a lot worse at this point in time than McDonald's. Tier 3. 42 to 53-year-old investors. These are the ETFs that I focus on in this category. Stuff like SCHD, VYM, DHS, things that are going to be yielding in the 3 to 4% range with a lot of high quality dividend positions in them. Top 10 favorite stocks to focus on here. Pepsi and Procter and Gamble are appealing in this age tier right now. The in-tier value, of course, is Hormel as well as Pepsi. You can buy the dip on United Health, Nike, or Target and get fine starting dividend yield on all of these. I am going to be continuing to add to these 3 positions, even though I'm outside of tiers 1 and 2 now. I like getting these stocks at a discount. And then again, American Tower, Archer Daniels Midland, keep an eye on those. And then for our tier 4s, I prioritize a ton of income generating ETFs once you get into that 54 and older category. Plenty of wonderful options that are here, and I like to spread the love out amongst a lot of these different things because you're going to get exposure to MLPs, high yield bonds, preferred shares, real estate, Bitcoin, covered call ETFs, just the best of all of those categories. And then you could be adding Pepsi at this point if you were still wanting to add some growth to your portfolio. Hormel and Target are going to give you starting yields above 5%. So if you want some single stocks, Great opportunity at age 54 and up. So I hope you all have a happy Thanksgiving weekend coming up. Let me know what you're buying and don't forget to buy early this week.